I think based on this comment alone, we saw rates stop climbing, because of the idea that maybe the path would be continued rate cuts from here. Stocks pick up modestly from the lows, and gold even started coming back up slightly as well. There's a lot to unpack this week with the Fed press conference from yesterday and the market reaction. I'm Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue, and our goal every week is to bring to you the market news, the data, the trends that we're watching, hopefully weed out some of the noise along the way and leave you feeling more empowered after every interaction. First off, I apologize for the little more casual attire here. I'm actually on my honeymoon this week, so I'll be back today, but very excited to kind of get into things here and break down a little bit of what we heard from the Fed yesterday. Before I talk about the Fed from yesterday, a couple things I wanted to touch on is just a refresher from some of the data last week, because this really fed into the Fed's comments this week. One of them is the employment report. So keep in mind on Friday, the employment report showed a very slow addition in jobs for the last month. And then we also had inflation come out and mostly in line with expectations, let's call it. A few outliers for sure, but mostly in line. In addition to that, we also had consumer sentiment this week. So keep in mind, again, lower jobs additions and in line with expectations inflation. But before we talk about the Fed, I do want to cover consumer sentiment and retail sales. Consumer sentiment was a bit lower than expected. Retail sales were up 0.6%. So quite a bit above expectations. And although the Fed actually talked yesterday about a challenged consumer, the reality is consumer spending remains to be a strong data point. Now, there certainly are some cracks with the labor market side of things and what that could translate to. But in general, if we look at this consumer spending data point, or retail sales, data point, certainly remains to be strong. Okay, so let's talk a little bit about why what we're all paying attention to this week. So we had the Fed decision on rates, and then also the press conference to follow just yesterday on Wednesday. So first off, the Fed decision was that they did decide to cut 25 basis points. So a quick refresher for those who tuned in last week, you may remember we covered expectations for this meeting. This is basically in line with what we had expected. There was some conversation about whether they should do 50 basis points or 25. Again, I kind of suggested 25 would likely be the scenario, and that's what we saw. There was one person that did believe that they should cut 50. So just as a heads up, there was a little bit of that as a conversation. Okay. The couple key things I do want to mention. One is that he had kept mentioning, so this is the press conference now to follow, kept mentioning that the downside risk to employment has risen. And you'll kind of catch that theme as we continue to break apart what we heard yesterday. But basically, what I want to cover is how the market reacted throughout this as well. So from the announcement itself, the market's barely budged off the initial news. Basically, almost all of it was flat. Gold was down slightly, but stock market, 10-year treasury, almost all of it was pretty much flat. Probably because most had expected this 25 basis point cut, as I had kind of shared last week. All right, and then we get into the press conference, and there's a couple things to highlight. One is that he had mentioned that their longer term expectations remain consistent with their 2% inflation target, and actually was asked directly how or why they can feel so confident in that, because that's been the conversation for a number of years now, looking backwards, and we still haven't gotten anywhere close to it. So this was an interesting comment, and again, this speaks to a lot of how they're viewing the risks between their dual mandate of the labor market and inflation. He did say that higher tariffs have begun to push up prices in some goods. That said, he expects that the inflation effects will be very, very short-lived and possibly just a one-time increase. They also did share that disinflation is happening in services. And the reason I wanted to highlight this is because you have heard me talk a little bit about money supply and how we look at that for inflation, and that tariffs themselves may not be inflationary as a whole. It may increase some goods, as it has, but not as a whole. And this is exactly, what he had kind of highlighted with the disinflation in services. So in other words, if food increases, but the cost for transportation decreases, inflation may not have actually gone up, right? So just keep that in mind, that when I say that, we're really looking at the whole picture there. As the Fed had continued to talk, again, really highlighting this risk of how the labor market is what they're really viewing in terms of risk versus higher inflation. As the Fed began to talk there, we actually saw yields pick up quite a bit, really because it was a very dovish Fed. Now, for the wrong reasons, maybe that's still a question, but nonetheless, a dovish Fed, and we saw rates pick up quite a bit. We saw markets drop a bit, gold dropped a bit, and dollar stronger. And all of this happened pretty sharply, but not too significantly. Okay. Now, the question is why a 25% cut now, and how do they view all this? So basically, again, what he had shared is that they feel like the risk to the labor market is much larger now than the risk to inflation. He did share it's not so much about the risk to inflation staying where it is. He mentioned that they don't feel like the risk to inflation increasing is too high, and the risk to the labor market decreasing is the concern. He shared when answering this question that he does understand that their policy path does matter. And the reason I'm highlighting this is because I think what he was kind of saying here without saying it directly is that they have a path now through the end of the year and they're likely to follow it. Now, he covered that up by saying we'll reassess the data every meeting, but in general, this really meant that they are likely to follow this path, I believe, through the end of the year, and trying to signal that to the market of what to expect ahead. I think based on this comment alone, we saw rates stop climbing, because of the idea that maybe the path would be continued rate cuts from here. Stocks pick up modestly from the lows, and gold even started coming back up slightly as well. Now, fast forward to the end of the day, basically what we saw was the markets were roughly flat. Gold was down a bit, and the 10-year Treasury was up about 30 basis points or so, or 0.3%, on the price, not the actual yield itself. Okay. And again, all after kind of this whipsaw effect, but not a whole lot to speak of. Now, today on Thursday, rates have increased again quite a bit, so definitely something to keep an eye on. But a couple of things I wanted to highlight. He had mentioned that they really view this cut as a risk management cut. So just kind of keep that in mind, especially as we talk about Fed through the end of the year. And basically what I heard is that they're basically suggesting they're okay with higher inflation for longer. They raise their inflation target and still cut rates. So I think in general, they are not too concerned about 2% inflation. I think if inflation were to pick up, that might change the narrative here a little bit, but I don't think that they're too worried about inflation at the moment. And again, really looking at the labor market as the thing to watch. Okay. So we'll end it there. What I will share is that we're going to skip the question of the week here this week, with so much to cover anyway. But be sure to tune in next Thursday. Next Thursday, we have new and existing home sales, as well as the GDP revision here coming out as well. In the meantime, have a great upcoming weekend, and we'll see you next Thursday at 3.